Crossing the $5 million annual recurring revenue threshold traditionally signals a company has moved past the survival phase. It is the hallmark of a real business with a proven story, built by founders who have demonstrated they can execute. But as those same founders attempt to scale further by raising institutional capital, whether through credit, venture debt, or private equity, the momentum frequently stalls. Outside parties lack the tools to independently verify an internal ledger. Regardless of how solid the financials are, they remain locked behind company walls, inaccessible to rigorous underwriting. This creates a trust deficit. Institutional capital providers simply discount unverified claims by default. At this scale of growth, the primary bottleneck to funding is no longer the math itself. It is the ability to prove that math is accurate to a third party. The trust deficit imposes a compounding economic penalty that drains resources across three specific areas of the business. Boards debate data provenance instead of strategy, creating strategic friction. Operationally, founders pay a 60-day diligence tax, rebuilding data rooms from scratch for every lender. Finally, investors price the risk into deals, causing valuation haircuts and higher dilution. Founders are paying a measurable price for their lack of external verification. They have won, but they have paid for it. This friction is not a new feature. Prior to 1909, public bond markets were equally opaque, defined by a lack of standardized trust. John Moody solved this bottleneck by introducing a single, standardized document of trust. For the first time, investors could rely on independent, expert-validated credentials instead of performing their own diligence from the ground up. This shift occurred because clarity accelerates capital allocation. When the market can trust the data, money moves faster. Modern private markets have been trapped in a pre-standardized era, waiting for a unified way to prove their financial identity. QuantPillar provides that institutional proof layer, modernizing how private companies interact with capital providers. Instead of custom-building data rooms, founders use the capital passport. First, QuantCore keeps numbers live and defensible. Second, QuantVal provides expert-signed 409A and solvency opinions for underwriting. Finally, QuantTerminal makes your verified presence visible to searching institutional capital. Together, these pillars collapse months of back-and-forth friction into a single trust link that can be shared with any counterparty. This shifts the entire timeline of a deal. Because the lender and investor package is pre-staged and verified, traditional diligence compresses from several months of friction down to a few days. This creates the NICE advantage. Ranking on a verified league table allows acquirers and institutional capital to find you first, often resulting in inbound interest at better multiples before a formal process even begins. There is also a defensive benefit that lasts long after the deal closes. Roughly a third of all private M&A disputes stem from post-close representations and warranties claims regarding the company's financials. A time-stamped independent record built before the sale is the only effective defense against these claims. You cannot build a defensible record after the claim arrives. It must exist pre-deal. This level of financial readiness gives founders command over their time and their narrative. It ensures you enter every room, for every raise or exit, verified and on your own terms.